Good morning, everyone, and thank you very much for joining me this morning. This is the DAX Open with myself, Russell Shaw, Senior Market Specialist at FXCM. My email address, r@fxcm.com. Today is Wednesday, and it's the 5th of January. I'm just going to bring up our high-risk investment warning, and what I'll do also, we'll do a NFP live trade this Friday. If you'd like to join, I've just put that link in the chat. So certainly come along and join if it's something you want to participate in. And here's our market commentaries disclaimer. I'll keep that on screen for a few moments as well. And just our references, Market Scope 2.0, I beg your pardon, I'm also going to be using the cnbc.com market note. So I'm going to go there first. I should have put that in the references. So just please take note, cnbc.com, and the market note reads, European markets lose momentum amid rising US bond yields. We have written about this actually on our Insights web page. So it does look as if the yields are starting to move up. In fact, let me just add trading view to the references that we'll consider this morning. So I beg your pardon, on the references, there should be cnbc.com and tradingview.com. All right, let's just take a look here. European stocks are expected to open lower on Wednesday as global markets reacting to rising US bond yields. European markets are expected to follow the US broadly negative. This was trend set overnight in the Asia Pacific region, where investors are closely monitoring interest rates in the bond market, with US Treasury yields rising at the fastest New Year pace in 2 decades. The benchmark 10-year US Treasury rose to 1.71% on Tuesday. Okay, let's just go a bit down. The 10-year yield is important since it influences lending rates for mortgages and many other businesses and consumer loans. When bonds sell off, yields or interest rates go higher. We have dealt with it in the past in a ad hoc webinar, just the inverse relationship between bond prices and yields. If anybody wants to refresh, send me an email, I'll send you the link. Investors are waiting for the release of the Fed's minutes, and that's from the December meeting. Central Bank announced last month that it's going to speed up the tapering of its bond buying program and also forecast 3 interest rate hikes for 2022. Meanwhile, US stock futures were flat in overnight trading after the Dow Jones Industrials notched a record close as investors flocked to shares that stand to benefit from an economic recovery. Data releases in Europe on Wednesday include final PMI data for the Eurozone services and manufacturing industries in December. Okay, let's just see if there's anything else there. No, that's it. Let's go here. All right, let's also spin this around here. Okay, so I think this is the dollar at the bottom. Let me just double check that. Yeah, that's the dollar. All right, so I'm going to take the dollar off. We won't do anything on the dollar, but what I just want to point out is we've got the US 10-year yield over here. Let's just put in 2 indicators. Let's put in the RSI first, and then we'll put in the stochastic. So all right, so this is a supposed updated RSI. I don't want any. I'll take this off. It's weird. All right. Haven't seen that before. So we'll make that 10, HL2. Let's just make it a little bit stronger in color. And gee, they've changed this a lot. All right, sorry, just had to get my head around the new settings. So just in terms of the RSI, the takeaway here, of course, is we're not overbought. All right, so in other words, there's still plenty of room for the yield to move before bonds become oversold. In other words, the way that would work is bonds become oversold. There's a bounce. As the bond prices bounce up, yields come down. There's still lots of time before that happens because we're looking at a weekly chart. We know we're near overbought just yet. So that's the first thing I wanted to show you. Let's take that out. And the next thing we want to keep an eye on is the stochastic. So let's just bring that in. And here we have the stochastic, which is, so let's put in a rectangle here. So you can see that we've just crossed positive on the stochastic. If you zoom in on our actual yield here, so let me zoom in here. Okay, you can see there's a golden cross here, right? A golden cross, there's a bullish cross on the EMA. So we've got a bullish cross on the EMAs. We've got the stochastic that's crossed positively, I beg your pardon. And now, those are two bullish triggers. The next part of the analysis is to keep an eye on the 80 level, right? Just like any other instrument, because once we start moving towards that 80 and we actually hold that level, there's going to be a momentum behind yields. So technically speaking, you can see the market seems to be responding to in a way that is pushing bond prices down, pushing yields up. That makes sense given the fact that we are in a rate hiking environment. The question for us and the difficulty for us is, well, okay, fine. How does that affect the instruments that we want to trade? And this will affect those instruments. So we just have to keep an eye on this chart. Just straight off the top of my mind, it would suggest to me that yields, higher yields, tend to be dollar supportive. The reason that is, it's quite a strange phenomenon. Although prices are declining in a rising yield environment, when I say prices, I'm talking bond prices, rising yields attract the interest of income investors. Now, income investors don't job the bond market. They would buy and hold to maturity to earn the interest, right? So the higher the yield, the more attractive the interest-bearing securities become to fixed income investors. So in my mind, it's potentially dollar support of that. The other thing that we've got to consider as the year sort of evolves is that interest affects valuation models. Okay, so banks work off valuation models, and the rate of return. So the way that this would typically work, let me bring in my Microsoft Paint. So the way this would typically work, we're not going to do a full-on model, but I just want to give you guys an idea, is that models work off what's called a required rate of return. which is an assumption. Okay, there's no absolutes here. So there's a required rate of return. So the fundamental analysts that are putting the required rate of return, well, they'll start with what's called the risk-free rate. So this is where they'll start, the risk-free rate. So that is what interest rates are without compensating anybody for inflation. Okay, so they'll just start off, and interest rates can go up or down based on demand and supply factors, not taking into account inflation. So they're going to take, so the first thing a required rate of return needs to include in their model is a risk-free rate. The next thing they're going to have to include is an inflation adjustment, because you have to be compensated for inflation. Now remember, we are in a environment of high inflation. Okay, so this adjustment is going to be higher than it was, say, a year ago. But then you're going to have to add other things in. Well, I need to be compensated for market risk. Okay, so I need sort of a risk adjustment if I'm going into equities. So what happens is when we have interest rates moving, okay, well, you can already see that the first term is going to have to adjust upwards. Inflation, I'm pretty sure well, I've got to be careful. I don't think that there's much more inflation to come. I think we're kind of at the top of the envelope. So I'm not sure what kind of inflation adjustment, but I'm not sure what kind of risk adjustment the analysts are going to put in. Say, well, we've had a terrific bull market now since March 2020. It's getting perhaps a little bit maybe it's run too fast, too quickly, whatever. They may adjust the risk adjustment here. But the fact is a yield movement is going to affect these two terms. So what's the big deal about this? Is that the way that these models typically would work, again, we're not going to do a full on, is we're going to just go say, let's just say stock value, okay, would equal some sort of, let's just put a dividend here, divided by, okay, and just to make it very simple, we'll just put 1 plus R. We're not going to make it more. In other words, so that R is your required rate of return, okay? That's your required rate of return. Now, the way, perhaps it's better if I put it this way. Let's do it this way. And this way, okay? So let's put this one. Let's put a stock value here. I'm going to put an equal sign there. Okay, so this is exactly, so it's the same thing, stock value over 1. So anything over 1, like 2 over 1 is 2, 3 over 1 is 3, right? So stock value over 1 is stock value, equals the dividend divided by 1 plus R. So the reason that I put it into this is because you can see that the stock value here, okay, the stock value is inversely proportional to 1 plus R. Why do I say it's inversely proportional? Because this is the denominator, this is the numerator. Stock value is directly proportional to any cash flows. So in this model, we've put dividend, but it's inversely related to 1 plus R. In other words, as R goes up, it's going to put pressure on the stock value. Oh, sorry, that's definitely not correct. It's going to put pressure on the stock value. So that's where we're going to leave it for that, because I don't want to get more in depth in that. But the point is, this over here, this, by the way, has already got the inflation adjustment in. So this is the real plus the inflation adjustment. That's what we're looking at on this particular yield. That's moving up. Well, if that's moving up, remember, it's inversely related to stock values in fundamental models. Okay, so how's that going to affect the stock market in 2022 is something that we're going to have to deal with. So this is a very important chart that we're actually looking at. It's going to affect the demand for currencies. It's going to affect the valuation of risk assets as well. And from there, it's a chain reaction, right? It will have a bearing on almost any other tradable instrument. It will have an effect on gold. How does rising interest rates affect the demand for gold? This is all a discussion that you're not going to have over the coming months. So this is a very, very important chart, and we wanted to see where we get relative to the 80 level here. All right, let me just see if there's any questions. Hey, Howard, what are the EMAs? The EMAs here, these are exponential EMAs. And you can see they are 5 and a 10. I always use a 5 and a 10. And just, I got this off of the Bailey Pips website. I just saw an article, tried them, seem to work for me. I don't think there's anything magical about them. My friend, my dear friend, who introduced me to the markets many years back, uses a 5 and 20. So that's what he uses. But I'll use a 5 and a 10. All right. Just going through to now the. All right, this was from yesterday. We did a scalp yesterday. Let's just. We'll do a scalp again this afternoon. Let's just go to the main layout here, and we'll do an analysis on the DAX. All right. Okay, so the cash market's just opened, and I haven't really touched on the DAX. Apologies for that. We'll get that. We'll get the analysis out shortly. I want to get this RSI out. All right. Very similar analysis to yesterday on the weekly chart. The morning note says that there's potentially going to be a bearish start to the week. Well, we'll see what the charts say. So we've got a higher trough, higher peak. Hey Shadrach, yeah, we can. Shadrach just asking if we can take a look at euro and pound. Yeah, we definitely can. So we've got a higher trough, higher trough, higher peak. But now take a look where we are. Okay, so we've hit this overhead resistance, and that may be the key reaction level. So that's something that we've got to just keep an eye on. I'm not sure why I've got the question marks in here. This is definitely a higher trough, higher peak in terms of my interpretation. We go through to our oscillators. Again, we've got a nice cross here. It's all about now hitting this this 80 level. Go through to our daily. It's looking pretty good, isn't it? I mean, we're in the positive area. This is zone 1. As long as we stay in zone 1, there is a heightened probability of price appreciation. You can't have a price appreciation to any meaningful effect if you are in the neutral area, zone 2, and definitely not if you're in zone 3. Well, we're in zone 1. So we seem to be on the bullish side of things. We go through to our hourly, and despite sort of the morning note, I think this is looking pretty good as well. Okay, so you can see that we've let's do it like this: 1, 2, 2, 3. Okay. We've got a bullish cross here. We've got a bullish cross here, and we've got a bullish cross here, and we don't have any signs of froth, no overbought conditions. So the triggers themselves look pretty good. Does it mean that this trade is going to work out? And of course, the answer to that is no. It doesn't mean that in the least. what we do need to keep an eye on is the upper quintile. Okay, so the stochastic needs to make its way to the upper quintile and hold, and if we get the movement to the upper quintile and we get the stochastic holding that 80 level and above, then I think there's a momentum that is going to be bullish. So we've got the triggers. Now it's up to the market to cooperate and provide the momentum. So that's the DAX. We'll just have a quick look at the euro and the pound. So let's have a quick look at euro. So we're in downtrend here. I think with a strong momentum downwards. Let's just go down to the daily here. And I think that the movement from zone 1 into zone 2, so this is the the bearish move right here, Shadrach. But of course, we really need the daily to get into zone 3. And I think if it does get into zone 3, there might be something to work with there because there's a squeeze here, right? There's a squeeze. So still not in that the ideal zone on the daily. Okay, I think that if we can get a movement into zone 3, it's to me more bearish for a short. And let's go take a look at the pound. All right, so pound's actually showing strength, isn't it? Let's take this out. So we've got, to me it's a tough chart. It's going to be a tough analysis. We've got a peak trough, lower trough. There's no doubt this is a lower peak. Okay, then we've got the lower trough here. And now, so the trend's down. Okay, the weekly trend's down. The question is, are we going to get a lower peak here or not? Okay, so that's the question. If we take out this area, it would negate the downtrend, but it wouldn't start the uptrend. An uptrend would need to be something like that. Okay, but now the difficulty for cable traders is, well, okay, the downtrend seems quite obvious, but when you go to the daily, well, what's going on here? We're in zone 1, which is our area of strength. So there's an ambiguity there. To me, that's it's not ideal. I think we want the daily to reflect the weekly. We want the hourly to reflect the daily, and then we sort of have a good top-down analysis, which is lacking here. In fact, what we have here is a pretty good hourly as well, right? So you've got the EMA starting to show angular separation. You've got the stochastic starting to look good, all whilst the daily is looking very strong. But the question is, and this is a tough question to answer, is this truly a reliable leg? And given that the broader primary trend is down, this could be sort of a one of those sucker rallies, which is that do tremendous amount of damage. So I'll be a bit nervous to get a trade on with the cable until it clears up. I hope that helps. Shadrach. Just take a look. Chris, the NFP is in the chat. Just let me know if you can get it. If you have it, let me see if I can send this to everyone. Okay, I've sent the link for the non-farm payroll. Everyone should have that as well. Okay. All right. I think let's end there. We will have a live trade this afternoon. When I say a live trade on a demo, the NFP will be a live trade on a live account. So thank you very much, and I'll speak to you guys a bit later in the day.